Okay, now this is your second simulation related to capital structure part 1, and there are 2 exhibits. Now what do we have? WWW Incorporated is a listed company that is seen as a potential target for acquisition by financial analysts. The value of the company has therefore been a matter of public debate in recent weeks, of course for the acquisition purpose. The controller of WWW has asked you to use the information that she has gathered to calculate the value of the company and its debt using various methodologies. Use the information in the exhibits to calculate the company's debt and equity using the indicated valuation method. Enter the calculated amounts in column B, and what we have in row 1, total value of equity, book value of equity, market capitalization, total value of equity using sector price earning ratio, the total value of the equity using dividends discount model, and finally the total market value of 8% bond. Do we have anything else? No, that's all. Okay, so let's have a quick look at what do we have in the exhibits. So select financial information for this firm. We have net income numbers for year 4, 5 and 6, and the total dividends for year 4, 5 and year 6. Okay, what else? We have been given the balance sheet for the year 6 containing all what you expect on the balance sheet, and of course some relevant information that might be required for some later components of your simulation. So let's first see what is required. The first value we need to find out is the total book value of the equity. Now this is a fairly straightforward question, no science involved in it whatsoever. Now look at this. This is your equity. Common stock 20 million, retained earning 47.2 million. That's all. There are many other components of equity which are not there, like other comprehensive income, like you might be given any revenue reserves or capital reserve, like debenture redemption reserve, capital redemption reserve, dividend equalization reserve, and so on and so forth. So right now it's a pretty straightforward calculation. It's going to be 67.2 million. 67.2 million. Just plug it in. 67,200,000. And there you go. Straight. Market capitalization. Okay. Okay, so for market capitalization, we will have to use the balance sheet because there was some information given at the bottom of this exhibit. Now look at this. The common stock of this company has a nominal par of 0.5 face value and a market value of 4. Khalas. Now this is what you need to calculate the market capitalization. So right here, we have got $20 million of the value of book value of your equity of related to common stock only. So if you divide it with 0.5, this will give you how many numbers of shares are outstanding. So 20 million by 0.5 gives you 40 million. So it means there are 40 million shares outstanding. And if each share has a market price of 4, you just simply multiply it with 4. So you're going to get $160 million. This is what is the market capitalization of common stock. So just plug it in and you go on. So here we go. 160,000. Done. Next, the total value of equity using the sector PE. Let's see, it should be given right here at the bottom of this exhibit. Here we go. Okay, now what do we need here is the required information. It says the business sector of WWW Incorporated has an average price earning multiple of 17 times. Means the price to earning ratio, or the P multiple normally it is called, it is 17 times. So how do we calculate the value of the firm using the P multiple? So you have the formula. So value of equity is equal to the net income, which we will have to see in another exhibit, multiply by the P multiple. So what we need, P multiple is already there, 17. We just have to see what was the net income of the recent from the recent financial statement. So let's see. I think we will have it here. This one. Okay, we go. 10.1 million. Done. So your net income for the period was 10.1 million. 10.1 million times 17, that's the P multiple. So that should give you the answer. 10.1 is the profit for the period multiplied by 17. So it gives you 171,700,000. So this is going to be the value as per the question's requirement, 171,700,000. So just plug it in right here. The total value of equity using the sector's PE, and here we go, 171,700,000. So next part says the total value of equity using the dividend discount model. Now for this we need to consult the information given again at the bottom of this exhibit. Okay. Now we have to value the equity using the dividend discount model. What is the dividend discount model? It is the price of the stock is equal to the current dividend multiplied by 1 plus growth rate upon the cost of equity minus growth rate. Let's say, what do we have? Do we have the growth rate? Look at this. The growth rate of dividends over the last 3 years has been 6.27. We got it. This is G. Then do we have the cost of equity or current dividend? Current dividend are available in our first exhibit. We can get it from here. We don't have cost of equity, but we have all the components that we can use to calculate the cost of equity using the capital asset pricing model. We have got the beta, we have got the risk premium, that is RM minus RF, and we got the risk-free rate. What else do you need? So we can calculate the cost of equity using the CAPM. Risk-free rate is 3% plus beta is 1.5 multiplied by the RM minus RF is given in net 4%. So 1.5 times 4 is 6 plus 3 is 9%. So you have got the denominator, 9% is the denominator, 4.27% is the, 6.27% is the growth rate, and 1 plus 6.27 would be the numerator. Let us find what was the current dividend. So here is the figure for dividends. Now there are two ways you can do it. Either you can put this single value of $6 million dividend directly here. What you will get is the total market capitalization, right? The total value of the firm using the dividend discount model. Else there is a longer route. It will get you the same answer. You are going to divide your current dividends just paid with the 40 million. That's the number of shares outstanding. This will give you the dividend per share. You put this in here, dividend per share, calculate this all. This will give you the current market price of a single share. And then you again multiply it with 40 million. So instead of just taking the long route, you can just plug in the entire dividend payment. This will return, the formula will return the total value of equity using the DDM. So that will shorten things out for you. So you can plug the 6 million here. So I'm going to do it for you. 6 million times 1.0627 when the percentage is converted into decimal divided by 0.9 or 9% less 0.27, and that gives you 233,560,439.6. If rounded off to the nearest dollar as per the requirement, it's going to be 233,560,440. Halas. So plug in the numbers here. It's going to be 233,560,440. Done. Now the last part says the total market value of 8% bonds. For this we need to consult the balance sheet. Okay. All right, now look at this. This is the total book value of the bonds right here, 25 million. Okay, now what is the market price of the bonds? It's 1,111.60. And what is the par? Of course, it's going to be 1,000. So what you're going to do, you're going to multiply that 25 million with 1111.6 and divide by 1,000, and you will get your answer. So that's what I'm going to do. Book value of my bonds, which is basically par, times 1111.6 divided by 1,000. So when you divide by 1,000, this will give you the number of bonds that have been issued times the current rate will return the market value of your bonds, that is 27.79 million. So that's what we're going to plug in there. So it's going to be 27790,000, and that would end your simulation 2 as well. Done. All parts done within 13 minutes.